capacity utilization. So what resource you have, if there is any maximum optimum utilization of resource to increase the productivity. So after preparing a marginal cost statement, we will get to know what is the cost we are incurred. Now 5000 units, we are charging 6 rupee 50 paisa, the sales value 32,500. Now the total cost if you add together, so we will get 1,72,500. Hello everyone, a warm welcome to one and all. I am Natesh, lecturer in commerce, Vidhyaashram First Grade College, MYSURU, the Temple of Excellence. We are in the Unit 4, Session 5, 4th semester, B.Ba Management Accounting. The chapter name is Marginal Costing. Okay, and the today's session, today my agenda, make or buy, or decisions of make or buy, a problem which is related to make or buy. Make or buy means what? For example, in the assembly industry, if you try to take a best example for assembly industry, so there are different components, spare parts, they are expecting from the few products, few components themselves they are producing. The remaining parts, if it is available in the market, the company, they don't want to take any steps to go for producing themselves. So again they will try to compare the market price. If I try to produce myself, okay, what is the cost? Okay, they want to compare. So that is, if you take example for bakery, okay, so in the bakery, what and all they are expecting puffs or bread. If somebody outside, a third party are supplying, even the bakery people, they want to prepare using a marginal cost statement. They will find out, if I try to prepare them myself, so what is the cost? The same cost, if I am getting less than the preparation cost, in case of market, we are comparing, okay. So if I take the initiative to start production, what is my cost? The same product which is available in the market, very cheaper price, so better I can go for buy. So now the management want to decide, either I want to make myself or want to buy from the outside if it is available. So moving forward, so make or buy, the marginal costing. So the same statement we are following. So the same labors and materials, variable cost, fixed cost, everything is very important. If I want to find out either I am getting a profit or loss, so with the help of marginal statement only. So here the marginal cost means what? Which is an additions, right? So the decisions making process of make or buy, which is completely management, they are deciding. Either I want to go for make or buying from the outside. Involve evaluating whether the company should produce a particular product or component internally. So if they are producing themselves, so each and every components, if they start producing, the resource size is increasing. Of course, if it is readily available in the market, very cheaper rate, so better I can purchase. So how they can decide? Using the marginal statement. So or purchase it from the external supplier. If the same product what you are expecting, which is available in the market, or supplier are supplying, so that is buy. Here are some probable points to consider when make or buy decision using the marginal costing. So here only we will decide, either I can go for producing myself or purchasing from outside. So here making a decision making of make or buy, okay, the first one, when you are preparing or taking a decision, we need to follow, keeping in a few points here. The first one, cost analysis. We need to analyze properly what and all cost is incurred. The major cost like variable cost and fixed cost, okay. So determine the variable cost associated with the producing the product. Variable cost, okay, what and all the variations we are finding. So for example, using a space like 1200 square feet, if I am ready to produce 100 product, so there is a chance to produce 200 product. So the same rent what you are bearing, so which is always constant, which never change, we will call it as a fixed cost. The component in-house, such as a direct material, direct labors and variable cost. So the cost analysis we need to do. And next one, under this first one, access the purchase price of the product or component from the external supplier, considering the any potential quantity discount or bulk purchase benefit. So we will take the decision after calculating, analyzing cost, using a marginal cost statement. If I try to go for purchasing outside, what is my cost? If I try to producing myself, what is my cost? Keeping in the variable cost. Next point, capacity utilization. So what resource you have? If there is any maximum optimum utilization of resource to increase the productivity, so we need to evaluate the existing production capacity. Evaluating, we need to find out if there is any space, a machine, it is possible to produce more product, everything. Okay, so research whether the producing the product or component internally would fully utilize available resource. What and all available resource we are trying to get maximum benefit. Okay, moving again, second point, consider any additional fixed cost. Okay, any additional cost is required. Suppose if I am producing a 10,000 product myself, okay, I am getting the order from the any other needy people, they are placing an order. If I take the extra responsibility, if there is any additional cost or where, so incurred. So of course the rent and utility associated with the producing internal that may arise due to increasing the production, that is also we need to analyze properly. Next one, quality control. Quality and control is very important. So evaluating the quality control standard in both the house of production and external supply. If the quality is very important matters here, the quality is good, of course the customers are ready to accept. If the supplier are producing the same product, is ready to supply, the quality is not up to the standard, we won't accept here. And under the consider the company ability to maintain quality standard consistently, any potential risk associated with the outsourcing. If I start producing not only for investment, the machine input, what and labor resource, technical, okay, so the resource very important to maintain one specific standard. Okay, next, supply chain consideration. Supply chain which is talking related to in-house and out-house. So that means you are getting raw material, supplier point, okay, or dispatching, everything connected. Analyzing the reliability and availability of external supplier. Okay, so we need to, from this production point to end consumption, the complete supply chain we want to think here. And access the lead time. Okay, the leading time of for example, production is happening today, so which is not directly going for consumption tomorrow, so it is something lead time is required. And deliver schedule and potential risk associated with the lying on the external supplier. Okay, moving for the strategic factors very important. Strategic, which is set by the what kind of strategy you are selected, what and all the factors are influencing for setting a strategy. So considering the strategy importance of the product components, okay, in the relations to company core competency and long-term goal. So that is very important. If we are not maintaining standard, so of course the quality which is differ from the product, so the customer is not ready to accept, the customer is not ready to purchase. Next time if they purchase, then also next time they are not ready to go for purchasing your same product. So evaluate the potential impact on the company brand, the customer relationship and competitive advantages based on the make or buy decision. If the demand you are expecting too much, okay, the same product you are not making, you are not preparing, you are not producing, you are purchasing from supplier. So the first time he is ready to supply in time, the second time when you are placing order, if he is not supplying properly, you are going to lose your customer. So that's what the make or buy decisions very important. And the risk assessment, you need to calculate systematic risk which is connected and non-systematic risk which is connected to take buy or make decisions. Identify and evaluate the risk associated with the both options, such as production delay and quality issue, cost fluctuations and changing a market condition. Every factors are equally important. Okay, so the production, which is not a simple word, so which is elaborating or carrying a certain activity or going on, so obviously we need to connect everything. considering the impact on the company financial stability and cash flow and overall risk exposed to associated with the chooser option. So whenever you have a problem, of course there is a number of solutions. So we need to evaluate each and every solution what and all is available. Now solution, suppose you are not taking any steps to go producing, you are expecting a product from the other supplier. So the similar product they are producing, they are offering a very less price. So of course we need to think other different factor, quality matter, the lack of order placement, so everything. And now decisions making of make or buy, a firm make some product or parts or tool or component, or sometime it make to buy something from the outside. The similar product availability is there, means we can expect from the external source. So the management must decide which more profit to be formed. If the marginal cost of the product is lower than the price of the buying from the outside, so after preparing a marginal cost statement, we will get to know what is the cost we are incurred. Okay, and if it is more, okay, you are preparing marginal cost statement, so just for comparing for the market price, then the firm can make the product. Okay, obviously if it is market price is too high, market price is more, okay, then we will reject. If the market price is less, we will accept. Comparing, okay, marginal statement, preparing ourselves. Okay, now there is one question to understand much better. A radium manufacturing company find that while it is cost 6.25, okay, to make each components like 2730 X product. Okay, so the cost is incurred for 6.25. So the same product available in the market at rupees 4.85. Now very simple logic here. So from market price to the cost of production, if you subtract the difference, what we are getting, which is profit. So with the assurance continue supply, the supplier is giving assurance, I will continuously supply the product. The breakdown of the cost, the materials is given 2 rupees 75 paisa each, and the labor cost 1 rupee 75 paisa each, and the other variables cost is given 0.50, okay, and depreciation and other fixed cost is 1 rupee 25 paisa. Okay, the total cost you are paid 6 rupee 25 paisa, which is there in the market 4 rupees 85 paisa. So of course as a management want to take the decision, should you make or buy, because using the transparent information only we can decide, we can reject this offer. Anyway, the variable cost of manufacturer, okay, 5 rupees. So see here, the variable cost means this 3 item, and the fixed cost we won't consider. Fixed cost, either you are producing or not producing, you need to pay salary, you need to pay for rent, you need to bear the administration expense, which is a fix. So only we will consider to take a buying and make a decision using a variable cost only. So the fixed cost we are getting 5 rupee, market price is offered for 6 rupee 25 paisa, minus 1 rupee 25 paisa, which is the excess what we are charging here, the difference fixed cost 1 rupee 25 paisa. So but the market price available for 4 rupee 85 paisa, the fixed cost 1 rupee 25 paisa also added. Okay, it is not profitable to make a component because there is a profit of 0.15. Even variable cost is profitable to procure from outside. I hope it is clear. Moving for the next question. Due to industrial depression, okay, due to industrial depression, a plant is running at the present 50% capacity. Almost all the factory will run for 100% capacity or 80% capacity. 50%, which is not reaching a margin. So the following details are given. The first one, direct materials, variable. and direct labor cost is given, direct materials cost is 2 rupee, direct labor cost which is given 1 rupee, and variable overheads is given 3 rupee, fixed overheads 2 rupee, total cost is given 8 rupee. So we will consider only for fixed variable overheads. Okay. So next one, the total production for the month 20,000 units. And the total cost of the production 1,60,000. Selling price 1,40,000. Loss faced by in your company, if you start producing 20,000 units, you are facing a loss 20,000. Okay. Now there is additional information. An exporter offered to buy, they are offering using 5,000 units per month at the rate of 6 rupee 50 paisa per unit. Okay. So we are start producing for extra 5,000. Existing production only for 20,000, because we are accepting order from the okay, those who are placing an order 5,000 units. Okay. So we are charging for them a 6 rupee 50 paisa, and the company hesitate to accept the offer to fear the increasing in the already operating is going losses, because using a 50%. So the reason is due to depression. Okay. So we are facing actually loss is 20,000. If you start producing along with the 20,000 extra 5,000 units, either your loss what and all what you are facing loss 20,000, is it reducing or increasing? So that is only the management are bothering. So they are hesitating to take an offer. So advise whether the company should accept the decline to this offer. Okay, decline means reject. So what we are trying to do here, so we will prepare the marginal statement for in your company how much you are producing, and apart from internal production, we are accepting an offer from the exporter offer. Okay, now your existing production in your company you are focusing only for 20,000 units. Clear? Now additional, if I try to produce offer, we got around 5,000 units. Now we will prepare for marginal statement. So okay, so marginal statement, the sales value is given directly in the question 1,40,000, but when you are accepting 5,000, you are charging 6 rupee 25 paisa. So 6 rupee 25 paisa, what it's you are charging for 6 rupee 50 paisa. So we need to multiply into 6 rupee 50 paisa. Now 5,000 units, we are charging 6 rupee 50 paisa. The sales value 32,500. Now the total cost if you add together, so we will get 1,72,500. So from the variable of sales, we need to subtract the variable cost. We know the material, either you are producing 20,000 or 40,000 or 50,000, the same material you are using for the same product. Now the material cost is same. Okay, the material cost what it's given, we need to consider 2 rupee, 1 rupee, 3 rupees. Okay, so the material cost what it is given, the same thing, the material cost at the rate of 2 rupees, labor cost at the rate of 1, variable overheads at the rate of 3. Okay, so we need to multiply respected unit produced in your company and offer accepted from the external. So here material cost we know 2. Okay, the labor cost is 1. Okay, and fixed overheads material cost what and all it is given, the same format we are following here. Now 20,000 into 2. If you charge the material cost of 40,000, we are writing in the value basis the cost. If you want, you can extend one more column, cost per unit. Okay, so I have not written here directly. I am multiplying 20,000 into 2 and 20,000 into 1, 20,000. Okay, the same, even the 5,000, the same material cost is applied. 5,000 into 2 rupees material cost 10,000. Okay, and 5,000 into 1 rupee means 5,000 labor cost. Okay, and overheads, variable overheads, what how much is given? The same thing, 20 into 3 rupees 60,000. Okay, 5,000 into 3 rupees 15,000. Okay, if you take a respected total horizontally, okay, so we will get first one material 50, total material, the total labor cost to 25,000, total variable overheads 75,000. Now what we need to do, we need to take all the variable overheads. Okay, so we will get 1,20,000 from total variable. From this year we are getting 30,000, the total 1,50,000 we are getting. So from the sales, we need to subtract the variable cost because we are marginal statement, okay, according to format. So if you subtract 1,40,000 minus 1,20,000, we are getting a contribution 20,000. And from here 32,500 in minus 30,000, 2,500, we are getting a profit. Okay, so a contribution we are getting. The same thing, 1,72,500 minus 1,50,000, 22,500 we are getting. So of course there is a fixed cost. Okay, the fixed cost rate also is given. Okay, 8 rupees is given. Okay, now we need to fixed cost which is not applicable for the extra what we are accepting offer, which is a constant. We are focusing only for variable cost. Either you are producing 20,000, the fixed cost also same. Either you are producing less than 20,000, the fixed cost also same. So fixed cost less fixed cost from the contribution fixed cost, 20,000 into 8, if you multiply, we are getting 40. The same 40 we will take for extra 5,000. We won't charge for them because the same fixed cost only we are trying to run. Okay, so here nil. So here the total is 40,000. Now we need to take the difference here. So from the contribution, if you try to subtract the fixed cost, we are getting minus 20,000. Okay, if you take additional 5,000 order, so of course here we are not charging any fixed cost because the same fixed cost only we are producing the extra 5,000. So here positive 2,500. Of course, if I try to focus only for 20,000, I am actually facing loss for 20,000 because of accepting an extra 5,000 order. So we are trying to reduce 2,500 loss. Actual loss now 17,500. So the firm must accept the offer because the amount of loss stand reduced to 20,000 to 17,500. Keep on watch for next section. Thank you.